High earners often assume Social Security won't matter much in retirement. But here's the truth. Even for those who've earned well throughout their career, Social Security remains one of the most reliable, inflation-adjusted income streams that they'll ever receive. And if you've consistently earned at or above the wage base, you're on track for one of the largest benefits that the system pays. But high earners also face unique challenges: maximum taxable wages, steep taxation on benefits, Medicare surcharges, and claiming strategies that either enhance or erode lifetime payouts. Today's video breaks down what high earners need to know about Social Security, how your benefit's calculated, how taxes will affect it, and how smart claiming decisions can add tens of thousands to your retirement income. And before we dive into all that, my name's Ryan Knoll. I'm a certified financial planner and founder of NAB Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's get started. If you earn a high income, you already know that Social Security payroll tax only applies up to a certain limit. We call that the wage base. For 2025, the Social Security wage base is somewhere around $174,000. That means you pay 6.2% Social Security tax on wages up to that amount. Your employer will then pay a matching contribution of 6.2% into the system, or you will if you're self-employed. But income above that wage base is not subject to Social Security tax. If you consistently earn at or above the wage base for 35 years, you're positioned to receive the maximum Social Security benefit that the system allows. But remember, Medicare taxes apply to all income, and high earners also pay an additional 0.9% Medicare surtax above $200,000 if you file as a single filer, and $250,000 for those of you married filing jointly. So while Social Security caps, Medicare doesn't. So you might be sitting there saying, hey, I'm a high earner. How are my benefits calculated? Well, Social Security benefits are based on your highest 35 years of indexed earnings, not your last few years and not your income at retirement. The formula is progressive, meaning lower earnings get replaced at a higher percentage than higher earnings, but high earners still benefit because the high wages push them into the top tier of the payouts. For 2025, the maximum Social Security benefit at full retirement age is around $3,900 a month, or roughly $47,000 a year. At age 70, that maximum rate rises to around $4,800 per month due to delayed retirement credit, so nearly $60,000 a year in Social Security payout. If you're a high earner, the difference between claiming at 62 versus 70 can exceed $100,000 over your lifetime, especially if you live into your 80s or 90s. But don't just fixate on the potential value. Build it into your financial plan to determine when the right time to claim is. It's not always at age 70, which is what I find out for a lot of clients. Now, here's where high earners get surprised. Your Social Security benefits can be taxed up to 85%. Unlike the payroll tax wage base, benefit taxation uses a completely different formula called provisional income. And provisional income is just your adjusted gross income plus half of your Social Security benefit plus tax-exempt interest. And tax-exempt interest typically comes from things like municipal bonds or something like that. If your provisional income exceeds the thresholds, which most high earners do almost immediately, then up to 85% of your benefit becomes taxable. For married couples, if you have above $44,000 in provisional income, that will trip the 85% taxation. For single filers, it's a little bit less at $34,000. And here's the twist. 85% taxable doesn't mean you lose 85% of the value. It just means that 85% of your benefit is subject to your marginal tax bracket. So someone with $50,000 worth of benefits who trips the provisional income mark would add $42,500 of their benefits as taxable income on their 1040 for that year. For high earners in retirement who are drawing from IRAs, pensions, or brokerage accounts, that usually means paying 22 to 35% tax on most of their benefits. This is why tax planning is essential, even if you're earning the maximum benefit. And for high earners, Social Security claiming isn't just about income. It influences your Medicare premiums 2 years later. Medicare Part B and D premiums increase if your income rises above certain thresholds. This is called IRMAA, or Income-Related Monthly Adjustment Amount. In 2025, married had surcharges starting at roughly $212,000 of income, and they climbed quickly from there. If you claim Social Security early and pair it with high IRA withdrawals or Roth conversions, you could trigger IRMAA surcharges, which can increase Medicare costs by thousands of dollars per person per year. Strategic withdrawals and delayed claiming often help high earners avoid these cliffs. So let's go over some claiming strategies for high earners. Because high earners often have multiple income streams, investments, pensions, IRAs, Social Security becomes part of a broader strategy rather than a standalone decision. So here are some of the key strategies. First is you may want to consider delaying Social Security to 70 if you're the higher earner. If you're married, the higher earner's benefit becomes the survivor benefit. Delaying your own benefit increases your spouse's eventual survivor income by up to 24%. Even if you don't need Social Security right away, delaying often maximizes household lifetime income, especially with a bigger age gap between spouses. Second is you want to use your 60s for Roth conversions. High earners in retirement often have huge pre-tax balances, and future RMDs start at 73 or 75 and can spike taxes later on. Delaying Social Security gives you several low-income years to do Roth conversions at 12 or 22%, shift taxable income into lower brackets, reduce future required minimum distributions and IRMAA surcharges, and create flexible tax-free income streams later on. This is often one of the most valuable planning moves for affluent retirees. The third step is coordinating Social Security with taxable and tax-free accounts. If you retire before you claim Social Security, you can draw from your taxable brokerage account at up to the 0 or 15% capital gains tax brackets. You can convert pre-tax IRAs up to more favorable brackets, and you can delay your Social Security to continue to maximize your benefits later on. Once Social Security begins, your provisional income will rise, reducing room for conversions and creating more taxation. Coordinating the timing of all three buckets, taxable, tax-deferred, tax-free, is very crucial to your success. If you want to walk through of how to do this, I suggest watching another video on our channel, Retire in the 12% Tax Bracket, the secret to a tax-efficient retirement plan. This will go over the strategy we use to keep your taxation on not just Social Security low, but on your total portfolio withdrawals. And before we jump into the last two claiming strategies, I wanted to thank you all for taking time to watch our videos. We've been working hard to get great content out to you to help you on your retirement and investing journey. So if you're finding this advice helpful, please throw us a like and subscribe so you don't miss any future updates. Now let's go over the last two strategies. The fourth strategy is letting a break-even analysis dominate your total claiming strategy. High earners often ask me, when do I get more total money, claiming at 62 or 70? But break-even isn't the only factor. For high earners, these matter a lot more. Things like survivor benefits, IRA and RMD tax planning, Medicare thresholds, cash flow flexibility, and long-term inflation protection. Focusing on the broader plan usually results in delay because Social Security's guaranteed 8% annual increase between the ages of 67 and 70, plus lifetime inflation adjustments, is extremely hard to beat with safe investments. But for those of you who have a shorter life expectancy, value current cash flow, or just feel that the government owes you after years of paying in, can claim their Social Security benefit earlier. But don't just claim early for the sake of doing so. Do it with a plan. That is the number one mistake I see people who claim early make. There is no plan or intentionality behind the decision, and then they end up paying thousands more in taxes over their retirement because of an inefficient decision. The fifth strategy and the final one is using spousal benefits strategically. Even in high-income households, one spouse often has a noticeably higher benefit. Options include lower earner claims first for some income, higher earner then delays until age 70 or a later date. Survivor benefit is maximized in this instance, and taxes can be managed more effectively. This coordinated approach can add tens of thousands in lifetime benefits. It also helps protect the surviving spouse when the lower Social Security goes away after the other spouse passes. Not planning for the passing of the spouse is one of the main reasons I see a healthy retirement balance dwindle more quickly than it should. Now that we've gone over the 5 claiming strategies for Social Security, let's talk about what high earners tend to get wrong when it comes to claiming theirs. And there's 3 big misconceptions that repeatedly come up in my experience with clients. Misconception number 1 is that they think they make too much for Social Security for it to matter. And that's false. Even earners receive nearly $60,000 per year with a cost of living adjustment each year at age 70. The second misconception is I should claim now because my benefits might go away soon. And while reform is likely, high earners will not lose all of their benefits, and delaying is still optimal in almost every single scenario where there's longevity in the picture. But there are reasons, as we outlined above, to claim earlier rather than later, but just make sure you do so with a solid plan. And finally, the third misconception is that their benefits aren't taxed. For high earners, we know that they almost always are. Managing provisional income matters. Make sure you're not paying more than your fair share in taxes with a sound strategy as to when you should claim your Social Security. So what's the bottom line here? High earners face unique Social Security challenges and opportunities. Hitting that maximum benefit feels great, but taxes, IRMAA surcharges, and poor timing can erode more income than most people realize. Here's what you should focus on. Understand the wage base and the benefit cap. Know how benefit taxation will affect your AGI. Delay strategically and maximize survivor benefits. Use your 60s for Roth conversions and tax planning. Coordinate your withdrawals across all account types. Avoid IRMAA surcharges when possible. And if you claim early, do so with a plan. Social Security isn't just a check, it's a foundational part of your retirement strategy. When high earners claim wisely, the benefit can be worth hundreds of thousands more over a lifetime. If you want help coordinating Social Security with taxes, withdrawals, and long-term planning, that's exactly what we do at NavWealth Partners. My team will help you maximize your benefit and minimize your tax bite. Thank you so much for watching, and as always, make smart money decisions.